Hello and welcome to Accounting 221. Today we're going to be thinking about inventory measurement, and this is another way of saying we're going to be trying to cost or determine what we paid for inventory that is sold. So there are two basic systems that we could apply. The periodic system, and we're not going to do this in class. You see that big statement up there, we don't do this. This is getting less and less common in the age of good computers. And then we're going to think about the perpetual inventory system, which is one you learned in Principles of Accounting, and indeed one we're going to use in intermediate accounting. So the periodic system, we book everything with a debit to expense, or a debit to purchases. Then we credit accounts payable. At the end of a period, we go back and count what should still be in inventory, and we do a reversing entry. And right there, there's a small mistake on the slide, but it's irrelevant because we don't do this method anyway. What we're going to have here is a debit to merchandise inventory and a credit to purchases. The perpetual system, on the other hand, is a system that we're going to look at in class. And this system adjusts inventory every single time there's a sale or purchase. Here, this is what you're used to. When we buy something, we debit merchandise inventory and credit accounts payable. When we sell something, we debit cost of goods sold expense and credit merchandise inventory. But the question here is, what should we debit cost of goods sold expense for, and what should we credit merchandise inventory for? Well, before we start thinking about that, let's realize that we use one of these two methods already. We use the gross method right now, and it's the one we'll be looking at in class, where we assume that we're not going to take a discount, and we record the purchase of inventory at its full price when we buy it. Later, if we choose to take the discount, we show adjustments to make the purchase price a little lower. The net method, the one we're not doing, assumes that we always take a discount because a discount is such a good thing. And here we actually record the merchandise at the lower price when we buy it, and if for some reason we didn't take the discount, we'd mark it up later. I know that when I was a young accounting student, my professor said we should always do the net method because everybody always should take the discount. It's beyond the scope of this part of the class, but I will tell you the discount, something like 1 or 2%, annualized over a whole year, is the same kind of concept that some of you all deal with payday lending. 2% loan, for example, for a week might be 100% over a year. And so the point here is similar. Taking a discount 20 days early for 2% would really be like saving 30-40% annualized. But again, it's beyond the scope of the class. The point is, it's a very good idea to take the discounts, but we're going to not record them until in fact we take them. There are four methods. Once we settle on the perpetual method of recording inventory, there are four methods by which we determine cost of goods sold expense. The first of these is specific identification, and here we're going to identify the cost of the items we sold by figuring out exactly what we paid for them. We might, for example, scan them with a barcode, and the barcode might point us to the actual purchase price we paid for these items. Typically, you think of specific identification being used for things like cars, where even in the 1920s, 30s, 40s, automobile dealers did not want to use another method to guess how much each car cost. Rather, every time a car was sold, they pulled their invoice price. And although it's beyond the scope of the class, that's not the invoice price that you hear in the commercials. This is getting more and more popular now with smaller items. For example, in the 1960s or 70s, Walmart's predecessors, notably Kmart, could not have used specific identification for small items like toothpaste. But now these items all have barcodes. Walmart could pretty easily track the cost price. Now, I'm not telling you whether they do that or not, but if they did, at the very point where they ran a tube of toothpaste across a scanner, they'd have their sale price, and they'd also record specific identification. Another method that a business could choose to track cost is average cost. And this way, at any given time there's a sale, we would think about all the items in inventory up to that moment. We'd think about any beginning inventory, we'd think about any other sales, and we would, any other purchases. So we'd think about beginning inventory, any other purchases. We'd add up all the total costs for all of the inventory we still have. We'd divide that by the total number of inventory items, and we'd come up with an average cost, and we would take each unit we sold and multiply it by that average cost. Now let me say one thing to make sure I don't forget it here. We are focused on cost. We're trying to figure out the cost of goods sold entry. We are not interested in sales price. So anytime you see sales price of inventory where we're trying to figure out cost, that's extra information. It's information that's not helpful and you shouldn't use. There are two other methods that are legal to use for accounting. One is first in, first out, and the other is last in, first out. Before we get to these two, let's think about the two methods we just looked at. So every business, by definition, uses specific identification in its physical flow of goods. Don't think accounting. Think the way the goods come in or out. Any business that uses specific identification, by definition, figures out the exact cost of the exact item sold. However, it's hard to imagine any business that puts all of its new and old items together in a warehouse and picks randomly when they're selling items. If they did pick randomly, average cost would probably be a good method to use, but few businesses do that. First in, first out says, let's figure out the oldest cost of the oldest items and consider those items sold first. Let's imagine a case where we've pulled all the old items to the front of the warehouse, and when we fill customer orders, we fill with those old items first. Then, if there are later orders, we fill with the newer items. That's the way most businesses operate. So to me, most businesses operate with some combination of first in, first out, and specific identification. And what I mean here is, you can imagine that on a very busy day where a shipment came in and lots of people called in sick, that lazy salesperson or lazy stockroom person, sometimes that's the same person, might just push the new inventory in front of the old inventory. So first in, first out is usually what companies set out to do. But sometimes, for one reason or the other, they don't use perfect FIFO. LIFO is another acceptable method, and this is last in, first out. This is where a company gets new items in, and it determines that it's going to sell those items first. And so imagine the case here, this is the way this would look, where that lazy salesperson or lazy warehouse person is on the job every day. And they just keep pushing the old stuff back and selling the new stuff. Now, I know this sounds absurd, but if you think about this in something like the food industry, imagine a case where a store opened in 1970 and bought milk. And since then, they never sold the first milk they bought, but they just keep pushing it to the back. The year 2015, ew, that milk would be pretty yucky. But before we leave this topic, I want to point out that these are not physical flow of goods methods. The accounting rules do not require that you use the same accounting method to account for the goods sold that you really use to move them. So most companies, to me, use imperfect FIFO. They try to use FIFO, the oldest ones in first are the first ones sold, But usually there's some kind of hang up like the lazy salesperson, or the pictures on some of the merchandise might be updated with new stars or something like that. And some customers might want the new star instead of the old one and ask them to go back. There's a story from my youth, and this will go to show you how old I am, where I was a fan of the Pittsburgh Steelers, and my father went out and bought me a football for my birthday. But the football he chose was Bart Starr, because Starr was playing for the Green Bay Packers, had been retired a year or two, but was at that time the greatest living football player. So Dad didn't think of me very carefully, so he didn't go to the store and ask that they dig in the back for the Terry Bradshaw football, but rather just went ahead and bought the one that was there. But you can imagine somebody now if, let's say that we had the Russell Wilson football from 2 years ago, and last year the New England Patriots won, and so they had some old Wilson footballs, but then they got a Brady football behind them, and then somebody's son or daughter wanted a Brady football for Christmas, and so the person actually said, well, you know, I've heard you've got some Brady signed footballs, can you give me one of those? So again, a lot of businesses are not perfect FIFO, but they try for that. But even though they're not perfect FIFO, it's okay for them to choose any of these four methods as far as the IRS is concerned. So and as far as the accounting standing setters are concerned. So for example, you could use last in, first out to account for your inventory at the same time it really comes in and goes out sort of FIFO. Consider this transaction, or these transactions. We have January beginning inventory. January 15th, we bought some new inventory. And then January 31st, we sold 30 cups. Not all 45 that we had in stock, but 30 of them. Also, I've put that dash there because the price of the sale price of those 30 is irrelevant when we're tracking cost. So under specific identification, we might learn from invoices that the ones we sold were actually 17 from the $5 tranche of inventory, and 13 of them were for the $6 tranche of inventory. This would mean that we have 17 cups times $5 or 85, and 13 cups at $6 or 78, for a total cost price of $163. The sale price of $10 for these is irrelevant, as I said earlier. Under average cost, this is what we would do. For that same set of transactions, we would first figure out the cost of all of the items in inventory, $250. We'd figure out that there are 45 of them. We'd divide 250 by 45, come up with 555, and then we would determine the cost price by taking 30, multiplied it by $5.55, the average price, and come up to $166.50. Under FIFO, we would assume that the 20 from beginning inventory were the first 20 sold, and then we would still need 10, and so we'd pick up those $10, those 10 items at $6. This would give us $160 under FIFO. Finally, under LIFO, we would assume that the newest stuff we just bought, the 25 items at $6, were the ones we just sold, and then we would still need 5, and we'd go back to the beginning inventory to get those. Total cost of that sale, inventory cost of that sale, is $175. Well, I hope you found this helpful. Let me know if you have any questions, and good luck.